One of New York's medical marijuana licenses just sold for $250 million to RIV Capital. That's a subsidiary of Scotts Miracle-Gro or Scotts Company. It's their investing arm for cannabis. We're going to talk about mergers and acquisitions, stupid money coming out of the table, what it's going to look like when you have all of this, Wall Street capital coming in, buying up people left and right, and what that looks like, what's to be expected. We're going to talk about all of that coming up.
It's only entertainment.
Welcome back to the Talking Hedge. I'm Josh Kincaid, capital markets analyst and host of your Cannabis Business Podcast. So you probably heard about Cresco and Colombia already. Now we've got this one from Scotts going into New York and spending $247 million to buy Etain Health. And so this is a Toronto-based company, RIV Capital. They signed an agreement with this female-owned and family-owned vertically integrated medical marijuana for a combination of cash and stock. So this is the largest female-owned business in the cannabis industry, or at least it was at some point. No longer now. Actually had an interview scheduled for the CEO of RIV Capital, but then Scotts is going to put in a different CEO, and so that CEO bounced like immediately. He's gone. So the new executive comes from Scotts. This guy Mark Sims. I'll be interviewing him coming up and find out what it's like writing $250 million check for a new state rollout in New York. I'll have to see how that goes. It's a lot of money, but it's not the most we've seen. So they're definitely expecting a lot to happen in New York to be able to throw that much down for just one area. Normally, when you see numbers like this, it's for a multi-state operator. For Harvest Health out of Arizona, for example, got bought out, but they have some Washington stores and some California licenses. And so they had multi-state deals, but this is really concentrated in New York. So this will be interesting. So they're one of New York's original 5 operators. They have only 4 dispensaries, including one in Manhattan. So if nothing else, they just spent a ton of money for that one in Manhattan. Because when this goes federally legal, like they just spent $250 million on what? Like the next thing you know, it's going to be just like opening up any business. So they're betting on federal legalization not happening right away. Otherwise, this deal wouldn't make sense. We're going to get into the example. I want to dive into a little bit more on the Columbia Care acquisition or the merger, and see exactly the accretive deal that Cresco is setting up. We're seeing consolidation is picking up. This would be a good kind of idea, kind of a showcase to show an accretive deal from an EBITDA standpoint, from bottom line, and how that's going to look. Because there's going to be a lot more M&A activity coming up. It's going to happen more and more. So I think kind of giving you an example to see what that looks like is going to be a good example. $2 billion is huge. So looking at Columbia Care shareholders receiving about 56 cents, 0.56 shares of Cresco for each share of Columbia Care. That's going to be approximately 420 million outstanding shares, roughly $1.4 billion. Stock prices aren't like I mentioned, they're pretty low, under $6 for Cresco and $5.97 closing price. The implied price for Columbia is about $3.33. So it looks like it's going to be a fairly accretive deal. When you look at the enterprise value, it looks like enterprise to revenues almost 2.5x, and enterprise to EBITDA is 11x. When you compare that to other companies, they only have 3.9 and 9.7 respectively. Although revenue might be a little bit higher, their earnings are less on average. The industry's earnings are less, but the industry's revenues are a little bit higher by comparison. Some of the financials aren't completely combined yet. When they are, it's anticipated that this is going to be a fairly accretive deal, and the market cap is going to create one of the largest, if not the largest, kind of cannabis company in the U.S. Based on market cap, so Curaleaf, Green Thumb, True Leaf, all still pretty big. But this combined company of Cresco Labs is going to have untapped debt capacity. Not completely uncapped. It's about $300 million, but that's a lot of debt to be thrown around there, especially when folks are gobbling that up right now. So that doesn't even consider cash position or further debt reduction. And that could be well over 250 million more. So we're talking about like $500 million easy. So it could be, again, an important catalyst for firming up pricing in the industry. You need to have comparables, public comps like this in order to know future pricing. And that could screw over a lot of other, select or supreme deals that came out buying companies in Oregon, and these, arbitrary valuations of, certain companies that were at 420 million, whatever. I think there's going to be a complete repricing of a lot of companies. And so this will be kind of that catalyst for that. It'll be really interesting to see how people readjust and recalculate what they're worth based on this deal here, because this covers Illinois to New York on a vertically integrated level. And so that consolidation from those two could be really, really interesting to take a look at and its effects down the road.
With that, we're going to roll this one up. I'm Josh Kincaid. This is The Talking Hedge. Don't forget to like, share, and subscribe, or don't, and I'm out.
Don't forget to smash that like button on your way out and check out these other videos that we've got.